Hi, this is Jim Lane, the economic realist, with some comments on our February 2026 monthly newsletter. The theme this month in the macro area um, is from a topic near and dear to my heart, which was the cartoons I watched as a child. And every once in a while I still watch them. But it's about these promises to pay down the road in order for there to be some advantage in the near term. The quote I used was from J. Wellington Wimpy, who was known as Wimpy in Popeye, when he would always say to the other characters, "I'll gladly pay you Tuesday for a hamburger today." Well, I think the U.S. government has been doing that for a long time, promising that tax cuts and benefit expansions and spending sprees will result in big payoffs down the road, which never has happened. What we've seen instead has been just the level of U.S. debt outgrowing the economy over and over and over. And I think that's coming home to roost. I mean, I don't know if it's 2026 or 2027, but it certainly feels like it's going to be very soon. We're seeing it in employment numbers, which, contrary to what I read or some of the people I talk to, who I have a lot of respect for, I just don't see the job numbers as suggesting anything but a fragile economy. Over 2 million job cut announcements in the Challenger report for 2025. That's only exceeded in the last 10 years by the COVID period. Um, Besides the major layoffs, companies seem to be pulling back on looking for new people. The JOLTS report, which is job openings, I realize it's a survey and we have to be careful with making too many conclusions about surveys, but it has been worsening. It has been worsening throughout the past 2 years. During the pandemic period, job openings were in the 11, $12 million job openings range, and now we're on the verge of breaching the 7 million mark. 5 million less job openings. I just don't see how that can be considered a strong or stable employment market. In addition, as I published earlier a few days ago, the unemployment rolls for those over 27 weeks, with most states having limitations up to half a year or 26 weeks, increased by over 450,000 in the last 12 months. Well, long-term unemployment is almost permanent unemployment to some degree. These are not signs of a strong economy. These are signs of possible stag in what we might be seeing as stagflation. Now, I think some mainstream economists, some pundits on TV and radio might say, well, 3% inflation is the new 2%, referring to the Fed's stated target of 2%. And we are bouncing around at 3%, although some things are up much more, some things are up less. Overall, it doesn't seem like in the near term we are getting back to the 2% inflation rate that I previously thought we would get to because of mainly the shelter component, which is about 30% of the indexes. But that seems to be holding up more than I thought it would at this point. I thought by the end of 2025, early 2026, that might even be at zero or possibly negative, given all of the news about rental declines. But in the single family market, while homes are staying on the market for longer, the prices that are being realized are not going to support a decline, I believe, in the shelter component, which again is 30% of the overall indices. So what I see is stagflation. I see real structural challenges in the employment markets and a fairly stubborn 3% ish inflation rate, all of which really ties the Fed's hands if they're truly looking at this from an independent perspective, which, as I wrote about in the monthly this month, I am suspicious that the new Fed chairman, Kevin Warsh, can actually maintain a truly independent Fed, given some of the news flow about his appointment and just how hands are tied with regard to our national debt, inflation, and the state of the employment markets. I think we're going to see a Fed that does everything it possibly can to stimulate using the short-term end of the U.S. Treasury market in particular. The overall economic data for the month was mixed yet again. I would say, positives balanced out with negatives, with the exception of employment, which is overall negative in my view. And then this month, I'm also recommending people take a look at what I think is a bargain in the business services area and is misclassified as a technology stock, misclassified as a software stock, which is shares of INTU, Intuit Inc. The shares are trading around $500 a share. I think your downside is in the mid 300s. I think your upside is close to a double, over 1,100. And I don't think that this is a pure play software company, but given that it's in the ETFs for software and the indices for software, it's gotten really beaten up in the last 12 months, down 17%. The broader index, the IGV that it's in, is down almost 11% versus the S&P up 14% in that time frame. So longer comments than usual, but wanted to introduce this viewpoint of stagflation and back it up, and I hope you get a chance to read the monthly newsletter this month. Thanks for watching.